All right. Howdy, everybody. This is Colin with Value Don't Lie. That's www.valuedon'tlie.com. It's an investing newsletter covering special sits and value investment themes. Today, I'm going to talk about quick value number 322. That's right, 322 of these things. This is Fubo. Fubo is the ticker. This is I'll call it an M&A theme. This is a recently merged company. Fubo combined their pay TV business with the pay TV business from Disney, the Hulu Live company. Before I jump into it, this isn't investment advice. Do your own research. Blah 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 blah. Right? Okay. So this is just for funsies. Okay. So Fubo. I first came across this when I saw the Disney transaction announcement. Pulled up the chart and it looks something like this. Shares absolutely annihilated, which of course got me pretty interested in wanting to understand what's going on here. Stock is still hanging around $10. There's 110 million shares outstanding for a $1.1 billion market cap. Put an asterisk around that. We'll come back to that in a moment. The company is targeting 300 million in EBITDA by 2028, which would make this pretty freaking cheap at a $1.1 billion market cap if they wind up hitting that. So that's kind of the backdrop, okay, before we jump into this. Quick background on what they do. Pay TV, so a virtual TV distributor, if you will, right? This is a competitor to YouTube TV, Sling TV, right? All of those aggregator type services where you're kind of getting the channel format. Fubo was originally like a sports focused offering, and Hulu is kind of the general audience version, like a competitor to YouTube TV, if you will. So those two businesses announced they were merging in 2025, and they recently closed on that transaction. Stock has been annihilated, and now we're trying to figure out what the heck is going on. Where do they go from here? So here's a quick look at the pay TV ecosystem, if you will. Spectrum/Charter at the top of the list. Comcast Xfinity up there as well. DirecTV still has a pretty sizable subscriber base, and I think YouTube TV is actually closer to 10 million paying subs as of today. So they're getting up there and pretty close to being top of the list. And I think they're seen as like the highest growth uh, player in the landscape. So you can see Hulu and Fubo combining makes them one of the larger players in this industry. And this is measuring like traditional cable offerings and the virtual cable offerings like YouTube TV. Cool. All right. So that's what they do, right? So it's a subscription revenue model is what the business is at its core. So a few things get me pretty interested in this. So Disney is now a 70% owner of this business. And a quick backstory, this company came public during the height of COVID, kind of had a meme stock aspect element to it. They had several of the larger content/media companies as investors on their cap table. And they, some of them made really good money. Like Disney was an early investor in Fubo, made good money, sold their stake, along with AMC Networks and some other media companies. And so then, the stock kind of fizzled post COVID and was sort of left for dead. Then, after all those media companies sold their stakes, they turned from being allies of Fubo to saying, "Hey, we actually need to get like legitimate economics from that relationship." And so margins wind up being pretty challenging for Fubo, right? So here's the financial profile, if you will. Let's see if I can zoom that in a little bit. 218 million in revenue in 2020, grew to 1.6 billion by 2024. Company was not making any money. Margins were getting a little bit better, but they were just hemorrhaging cash through that time period and taking on debt to supplement it, right? So things weren't going well. A couple of those media companies band together to form a competing offering called, I can't even remember what the name was, but it didn't last. So they tried to compete against Fubo, right, and held that business to different standards from a carriage deal standpoint. And Fubo sued, and as part of their victory over that lawsuit, Disney said, "Hey, let's take our Hulu live TV business, combine it with your Fubo TV business, and you give us 70% ownership. We'll give you some cash to settle this lawsuit, and we'll give you a term loan." Right? So they got those three pieces coming out of that lawsuit. So there was a lawsuit settlement, which really drove this merger between the two companies. It was a ridiculously and was and is a ridiculously complicated transaction. So it's an Up-C structure. Let's see, I got a chart of it somewhere. Yeah, very complex structure, which means that your traditional financial reporting services, like I use Koyfin and Ticker, they're going to give you the wrong enterprise value for this stock, like guaranteed they're going to give you the wrong enterprise value because they're going to double count both the minority interest on the balance sheet and the ownership structure of the Class A versus Class B shares. What you need to know is that Disney owns Class B, which are vote only shares of Fubo Inc., which is the publicly traded company. And then they also own operating company LLC units, which are non-voting. They're just the economics of the underlying operating business. And ultimately, they can kind of swap those out and collapse that structure, but they haven't today. That could come down the road. So this is the ownership structure. I think this is part of the reason this opportunity exists. Is pretty complex. So this was the end result of that lawsuit settlement. Fubo got some cash, they got a term loan, and they got this merger. And now Hulu, Live TV, plus Fubo are all one business. Sweet. Okay, so what does that look like? Well, now that they've combined these and kind of recut the carriage economics for Fubo to carry Disney's content, now the business is actually in a position to start making some money. So they're starting to turn a profit, well, at least turn an EBITDA profit in 2026, but they're telling investors, hey, by the end of 2028, we'll have at least 300 million in EBITDA for this combined business, right? And part of that is like a virtual lock because of this lawsuit mechanism. So they feel like, hey, we've got really high visibility to this, regardless of what happens with subscriber count and cost of advertising, acquiring customers, etc. So pretty good line of sight to call it 300 million in EBITDA by 2028. So if all that's coming into view, why is the stock in the toilet? Well, a couple things. One, we talked about the complex transaction structure, but two, at the time they announced this deal in early 2025, they were originally thinking that 2028 EBITDA number was going to be 550 million. And part of that was because they thought, oh, well, sweet. Now that we have this big subscriber base, we'll have way more negotiating power in creating these carriage deals. Turns out they went to, let's see, they talked about it on a call in their first renegotiation, if you will, under the merged entity. They were negotiating with what's now Versant from Comcast. And they were like, hey, we own both Fubo and Hulu TV. Give us a better deal. And Comcast was like, well, no, we've got a contract for Fubo and a contract for Hulu Live TV. So no, we're just going to wait. So they came to realize, hey, this is actually going to take a lot longer for these contracts to sunset and negotiate them from a power position of leverage. So anyway, I think this is potentially it's going to take longer to get to this 550 million as opposed to it's totally and completely off the table for reasons they can't control. Okay, so I think that's the backdrop. So my take is stocks in the toilet because complex structure plus reset, if you will, of those long-term financial targets. Adding to the fun, Adding to the fun, they just announced recently. Where is this? This was like super recent. It's now turning into a bit of a management change story because oh no, that's the wrong link. It's turning into a bit of a management change story because they fired they fired the CEO who was also the founder and actually brought in a Disney exec to run the business. Let's see. And this was the woman who ran. There it is. Okay. In July of 2026, they fired the founder slash CEO of Fubo, and they brought in the person who was responsible for basically building Disney Plus, the streaming service. So now you have kind of an outsider, if you will, external management change story, which is also makes this a little bit interesting, but opens up some questions for like, hey, this is now more or less a controlled entity through Disney. Like, could there be a take under at some point? Possibly. Do they have an incentive to see the stock work as an independent company? I don't know. I don't know. So anyway, what could shares be worth if you were to convert Disney's Class B shares so as if it, were all collapsed as one share structure? I get a 1.1 billion market cap under that scenario. I give them full credit for the 300 million EBITDA target. You put a 7x multiple on it. There's 150 million of net debt or so. That works out to $18 a share versus 10 today, right? And that's maybe the optimistic scenario. Comps are trading anywhere between, 4x on the low end, maybe 5 to 7x, depending on which media company you're looking at. So $18, maybe that's your upside. Maybe better if they wind up having more long-term success there. And then on the downside, I just took the fiscal 27 sell side estimates, 187 million as of today, at 5x, which is kind of the lower end of that comp set. That gets me to $5 a share. So it's pretty high upside, maybe high downside if the fundamentals don't pan out. They have yet to really turn the corner in generating cash, etc. But they feel like they're on the cusp of turning that corner. So they've guided to 300 million of EBITDA by 2028 and positive free cash flow starting in fiscal 27, and we're already more than half of the way through 2026. So it's a pretty interesting setup. I don't own any shares today, but it's sitting on my watch list. I've been thinking about it, noodling on it. The new CEO wrote a letter, shareholder letter, not a lot of meat to it, but I do think management change stories are interesting when they, introduce the concept of an investor day or analyst day meeting. And it sounds like they're going to be doing that. So I will be sharing a strategic update on our November earnings call, along with more details on our plan to deliver increasing shareholder value. So I don't know. Maybe this is turning into a pretty interesting special sit. That's an early innings turnaround / merger / management change story with maybe some updated long run targets coming in a couple of months. So let me know what you think. I'm just watching this one for now, but it could have some serious upside optionality if they get it right from here. So that's Fubo, tickers FUBO. Thanks.